Hi guys, so Randy here for the earnings season podcast. And just with a quick message slash reminder, what you're about to hear or see, depending on if you're listening to this or watching it on YouTube, is a conversation between myself, Danhai, and a really great guest of ours. It was such a good conversation. We had it go as long as we could. It was pretty long. I didn't want to bore you guys too much with it, just in case it was too much to take in. So we chopped it in the middle, and so you're listening to the first part of a conversation with a legend. I won't spoil it anymore for you. I just wanted to give you that heads up. And look out for part two coming up soon. I must also point out that yes, we did have some sound issues in this one. I think mostly me. Apologies for that. It's a little hard to hear in some parts, but you can get the gist of what I'm saying. And it's pretty clear. And more importantly, you can hear Danai clearly and you can hear our guest clearly. So listening, enjoy. And if you like it, if you're listening on Apple Podcasts, give us 5 stars, leave a review. It really goes a far way for us. If you're watching it on YouTube, give us a thumbs up, share it with somebody. Uh, if you're listening in any other podcast app, listen and enjoy. You see a nice little donate button there, click it. Throw a donation our way. If it's $1 from PayPal, we love it. It'll help Dana buy that Jeep maybe. Or it might just help us have more consistent episodes. Who knows? Anyway, thanks again. And look out for part two coming up soon and more things from us. I'm out. All right, hi guys, welcome to another episode of earnings season. As always, the show that is about business, stocks, investing, and whatever else Dana and I have on our minds. Yeah, and as always, we usually have either some really good ideas we would like to think, or some really good ideas and some really good guests. This week is another week with a really good guest. Uh,
Maybe wait.
yeah, a huge one for us. If we're so excited, it's because I don't think legend is too big
A word for this one. It's
a word
funny
for this
because
one.
we've spoken about him so much.
Yeah, right? Many times. But before we talk about him, let's
If
go
you're
ahead,
investing
Dana.
in Jamaica, then you know his name.
There we go. So before we talk about him, let's talk about two names that you may not know, which is myself. I'm Randy at RTU on Twitter.
And I'm Danhai Asian on Twitter.
And this is earnings season. And this week, we don't want to waste any time. We want to bring in our guest very, very quickly. The one and only somebody who I suspect you guys may have heard about, John Jackson, the legendary, I don't know what to call him, investor, chairman, CEO. These days, I've been calling myself a retail investor advocate. And I think the closest we've seen to something like that outside of maybe a legend like Mr. Staple and Ralph Chen back in the day would be John Jackson. So welcome to earnings season, Sir Jackson. How are you?
I'm fine, and thanks for having me.
All right. So, yeah, man, we're very, very, very happy to have you here. So, uh, I don't even know where to begin. There's so many things. I always try to start off with the thanks, because it's easy to forget the thanks when you get into the excitement. I should thank him. Then I know we have a whole heap of thanks for this gentleman because
Definitely.
he has managed a few of our companies and made us quite a little bit of money. Yeah.
And ideas too. He's led the way in terms of the information that will bridge the gap between something you're looking at and an investment in the thing you're looking at.
Correct. And I think for many people, especially in the earlier days of starting out, so now it's a lot easier with how the stock market is. But in the earlier days of starting out, you really didn't have that many resources. I seen Insider before I knew who John Jackson was. It was just what I read. And you just know the name. So in terms of as a regular retail investor coming up, especially in the early hard days when there's no, people talk about, the only thing is for the big man now. Back then, if you weren't going to the broker with a lot of money, you were on your own. So this is probably one of the very first resource places that you could get some information from as a regular person. So let me thank you very much for that, Sir John Jackson. You've helped me make quite a few millions. You're on the thank you list. You're very high on the thank you list. So thank you very, very much.
You're welcome.
Yeah, man. And you are, I don't know, I have your kudos here, but I don't even know where to begin. I don't think they're enough. You're on a bunch of boards. You were part of the early wave of showing what the junior market could do with JetCon. I got quite a few little hits for that one because that was one of the companies, and that's one of my first transformative experiences. Seeing something that's good, seeing something that is a practical, obvious business, and then talking to my advisors about it, and being told, I'll never forget the sentence. used car? You really have put your money in a used car? And the person that said that to me
Was driving a used car.
was driving a used car, drove home that day in a used car in traffic full of used cars, but couldn't see the value of a used car business being listed. And I remember JetCon being a little bit of a turning point for me in realizing that, wait, one, you can't really listen to what people are saying because they don't really know. Two, if you can see actual value and see a business that projects and puts out actual value to the shareholders, you don't need anybody other than the share price to justify what you know. It was a very transformative moment for me. And I actually lose a friend over it. He stopped talking to me when JetCon passed 70%. Literally, he said it was, you will see your money is going to burn up. And when it passed 20%, I said, what's up? Because I know at that point 20% was a big deal for him. 50% in stop talk, 70% in delete the contact. And it went on to over 100%. I mean, I don't own a lot of JetCon, no, but I mean, you know, it has really varied. It has moved up and down.
In the year after JetCon, was it JetCon listed in 2016?
That's correct.
Yes. I started working at an investment firm in 2016. So I think it was a little after it listed I started working. It was summer. I started investing at the start of 2017. And about my whole story, that I did a bad play with cable and wires because I heard somebody else talking about cable and wires. So my whole thought was just investing in cable and wires because people talking about it. Lost money there, save up more money, put it into the market, and I went to the JetCon, and I did really well there. And that was a change because it was no longer about listening to what other people are saying, but more about looking at the company, look at the numbers, and saying this makes sense. And the market proved me right.
Well, one of the things the story that Randy made remind me of my pastor at St. Andrew Parish Church. So in the early days, he said that he followed recommendations I wrote and bought shares. And from the shares he sold, I was able to buy his house. And his fellow pastors told him before he did that he was going to lose his shirt. So in the final analysis, he did what he had to do and was happy for the information that he gleaned, and he moved on. And the reality is that in many cases, we have to make decisions, and the issues I constantly remind people of is that Pan Am Airlines and Eastern Airlines and others were high-flying companies in their heyday. But where are they today? So the concept of buying stocks and holding on to them forever is not necessarily a good investment posture to take, because like people, companies' fortunes fluctuate from time to time, and that's something to bear in mind. The other factor that is of import that I learned some years ago when I attended a seminar in the United States is the virtue of diversifying one's portfolio. The virtue of reviewing your portfolio on an ongoing basis. And sometimes you trim back some of the investments if they get out of line and try and maintain a more balanced portfolio. So if one investment doesn't perform, as in your case, then you apparently bought one stock. But if you had actually bought a series of stock, maybe the cable and wireless would not have performed, but others probably could have performed, and you would have been well ahead of the game.
I love that. I love that.
It's a reminder for those people who invested a lot of money in cash plus and OLED. You know, forget about the actual type of investment. If they had followed that principle, they might have lost money, but many of them would not have lost as much as they end up losing, because they would not have put a significant amount of their wealth into either of them or the various ones that were available at the time. So the same principle applies then, applies now, and it applies. It may cause you to make less profit from an investment or investments, but it's life is one of balances, and sometimes you can gamble. And I had a discussion with a broker the other day, one overseas, and he said, well, if the investment that he made, he had actually bought options. If the investment he made had paid off, I would be praising them. And I said, the way I would have looked at it is that, yes, I'll commend you for actually delivering the profits, but I would berate you nevertheless for violating the principle that we had actually set out, that don't take excessive, unnecessary risk, because sometimes it pays off and other times it can be disastrous.
I like that. So we are. I like that you bring in this point, because we on this podcast, and I think in our own investment
circle,
we are.
We're not huge proponents of diversification necessarily, but
needless diversification.
Needless. I usually hear diversification thrown out as something to be done for the sake of diversifying, and not as a risk management measure. It's not. People don't diversify because they hear that they should diversify, and not necessarily because. So they also then you find that they over diversify, they spread it way thin. So they pick up stocks that they don't necessarily believe in because I need to be diversified. So I find a lot of that.
Well, the point is that there's nothing that says that you have to own stocks. I mean, if you're not convinced that there are good opportunities in the market, then one way of diversifying is to reduce your exposure in the market and put the funds in cash or in some other form of investment until you're satisfied that the market is conducive for you to, or for one to invest and expand one's investment in the market.
I agree.
So that we may have, one may take the view that, okay, I believe Bank of Nova Scotia or NCB, whatever it is, have a long-term future, and I'm prepared to buy into it and leave it, irrespective of what the fortunes may be. But then if you only have 10% of your wealth, or 5%, whatever the figure is, in NCB, if it evaporates,
then you only stand to lose 10%. Yes.
You lose 5 or 10%, and that's a general principle. It's like buying a house or a car and you're insuring it. You may never get into. In my driving experience, I've not had an accident that I am been responsible for. Right?
Me either.
But the law requires you to insure the thing, and you never know when you may actually make a mistake and hurt or damage somebody else's property.
Yeah, that is true. And as somebody was damaged, thankfully nobody else, but I have damaged some property from being a young and stupid driver in the past, in the far past. The insurance, that sort of risk management and mitigation is key. Now, what I like that you're mentioning it, because we have a lot of new people coming to the market now. One of the things I want to talk about is how you feel about the market now. And it's good to hear this kind of view, because like I know that what Danhai and I do, we tend to be at the forefront of the risk, right? We're the people who will put everything in one stock, and we do the research. So don't get me wrong, we're proponents of Buffett's theory, which is you don't put all your eggs in one basket.
Well, you watch that basket.
Watch that basket very, very closely. So we're doing that. But then also we have the kind of lives that allow that, right? None of us have children, unless things have changed recently, Danhai. None of us have children. We're not married. So we can afford to take on a bit of risk. And we have some disposable income. So we can afford to take on a bit of risk. But even I, as risk, whatever the opposite of risk averse is, but I'm actually pretty risk averse. But even I still diversify. But I don't preach it, because needless diversification has gotten so popular. So I like that what you have done. And if you've seen it, if anybody look on IC Insider, guys, check out. I can give him a free plug. It's a free ad. Check out ICinsider.com. He has years of what you call your top 10 picks. Do I have that right, man?
Yes.
And those are, well, you know what we've always said, Danhai, this is the perfect answer. I always said that I would love to have a conversation with him to know what the hell makes up these picks. So you can you can tell us there, Dan, what makes up these picks? How do you pick?
It's a simple computation. And I'll tell you the history of it. Back in sometime in the 1990s, I felt I needed to focus on making some money. And I remember getting up it was a Sunday morning, early Sunday morning, could have been 3, 4 o'clock in the morning. And I got the idea, go on my laptop and create a spreadsheet and start to rank the stocks based on the earnings and therefore the potential gains. And that year, I came up, the rankings threw up PanJam and First Life as the 2 top stocks with potential gains of 400%.
Okay.
And I said to myself, but nobody buys those stocks. They're not popular and what have you. So I think I bought the number 3 stocks, which did pretty well. But PanJam and First Life did the best in that year. And what I found is that it removed the matter of individual preference for likeness for particular stock, and allowed me to focus on the performance of the companies. So it eliminated that bias that one might have to one company or the other. And I just found that it worked like a charm. And my performance increased considerably as a result. So we did further studies to indicate that, and we have some work in over 30 odd years of the history of the market that says that the top 10 stock, only about 20% of those stocks repeat in a subsequent year. And in fact, the worst performing stocks of a particular year tend to outperform other stocks in the subsequent year. And it's a consistent bit of data going way back 30 or 40 years. I don't know if anybody else in this country have actually done that exercise, but it's just a phenomenal, consistent feature of the market.
You're talking to somebody who has done that sort of thing. I haven't gone back 40 years, but I've gone back pretty far and looked at those links, and you're correct. There is a
phenomenal, consistent history of so the person who hangs on to a stock because they like it and because it did well last year, are likely to find that stock. And because if we bear in mind, what are the factors that drive stocks? Profits and interest rates. Basically, those are the only 2 factors over time that really determine what the value of stocks are.
Over a series of years?
Well, even in the medium term, a year or 2, right? It comes back to P ratio, but primarily, but it's a combination of what profits are doing and where interest rates are likely to be. But so in a country where the typical company is not going to grow profits more than 20 or 30% per annum, in a market where stocks have gone up 200-300% in a year, what that performance is doing is discounting most, if not all, of the undervaluation of the stock, because they would have to come with another 100-200% growth in profits to be able to continue that growth performance. And therefore you move from stocks that have performed very well, because in most cases they have underperformed for a period of time relative to their true value. And they come because what one observed is that there's a rotation, and the people tend to where stocks are attractive to the majority of investors, everybody is like honey. Bees flock to honey, right? Probably less so to pollens. And so the crowd goes after the ones that are popular, and the ones that are not popular are left to languish. And the people who understand those things can look and say, okay, I am prepared to buy those stocks that are not as attractive to the mainstream investors, and just wait for the payoff. It's like QWI, which we spoke about last night. QWI is the second best, I think, performing main market stock this year.
So far this year. Yeah,
so far,
it's early in the year, but
it's up 50%.
Yeah, stunt a little. Let's go.
and that's not a bad performance with less than 2 months of the year to go.
Agreed.
That's not a bad performance. Let's give you your flowers. The market in its greatest year did not rise 50%. 2019, the market rose 31%. 2020, the market fell negative, I think, 12-something%. So to be up 50-odd% right after
the main market was down 23 or 24% or thereabout.
Yes.
And the junior market just about 21% down. So at the moment, the main market index or indices are down just over 1%. The junior market is up 7.5%. So the point is that the tendency is in markets is for people, especially when you have an influx of new investors. Many of them are looking for instant gains. And sometimes those, in an era where people have been brought to the market through IPOs, and in 90% of those IPOs have actually gone on to record strong gains. That is very enticing to people. When you make your first investment and it pays off very well, you're almost sold on the virtues of the market. And therefore, when a stock doesn't perform, people, and rightly so in many instances, get rid of it and cut your losses and move to another one. The unfortunate thing is that many people in cutting losses, in my view, don't go about it the correct way. The way to cut losses at times is to look for an alternate investment that you can actually recover from. And that makes it easy for you to cut your losses and recognize at a fairly early stage that the thing is not likely to bounce back in the medium term. But when you cut your losses at the end of the day, when the stock or the market has actually bottomed out and about to rise, that's just a bad way to go about investment. And if you looked at QWI shares, it started to inch up from the technical indicators pointed that it was going to go up from sometime the latter part of the summer months. It started to consolidate and started to move slowly upwards. So those are some lessons that, and it takes time to learn them. And the best will in the world is not a science; it's an art of sort. And you have to try and fudge out what can be helpful to people, but the average person is not going to avail themselves of that. Is the whole matter of technical analysis, which can tell you. I mean, we have written, you probably might have seen it, that the junior market was at the beginning of a bull market, the latter part of last year. The technical indicators, the golden cross, pointed to a fairly strong rally for the market. And based on the early days of this year, it suggests the market will probably go up to over 4,000 points by the end of the year. But at least it should be well into the 3,000 odd points shortly, once the earnings season is over and people digest those numbers.
So I have a lot of beginners who listen to this, so let me just do a quick translate. Yeah, so a quick translate. Pretty much what John is saying there, and you can correct me if I've been wrong, John, is that he has looked and he has studied the market for so many years that you eventually develop a sort of innate understanding for what certain events indicate will happen, right? And when you do that for marketing time, they call it technical trading. So that's it. That's trading on the technicals. And you mentioned something there, the golden cross, I think.
Yes.
Yeah. What was the golden cross? What's the golden cross that you see for the Jamaican market?
The golden cross for the junior market is the short-term moving average of the market, crossing over the medium term. So in the one that I've plotted, I use 20-day moving average, very short averages. So I think we have 50 days, 45, 50 days, which is roughly 2 months. Crossed over the longer term 120-day moving average, and that took place somewhere in around October, November, and the 120-day is in the process of crossing over the long-term 240-day moving average. And the last time that happened, the market went up some like 500-600 points. So it's not so much a matter of the history of the market. I try to do forex trading, and very critical part of forex trading is technical analysis. You have to you can do fundamental, but that's not the basic aspect of forex trading, because the market moves regularly throughout the day, and over a period of time it moves. But there are signals in terms of trying to remember the candlestick movements, and those things that have coded messages in them. That gives you some indication, if you understand it, where the things are going to go. There's also the matter of trend lines. I mean, in the U.S. market, one of the things, a stock that hit me very forcibly was Netflix, where Netflix is into a trend line, a channel. A channel is two trend lines, so top one and the bottom one, which provides support and resistance. So the bottom one provides support, so it hits it and it will bounce off. And the top one provides resistance. And the investors have been trading, the overall market is going up, but in between the going up, the stock is bouncing, is hitting the bottom support, and they drive it just before results are out or after, they hit it down. And you get these patterns that many people are at it regularly. Pick up, and if you're good at it, you buy on the low and sell on the high.
Quite so.
So the market may go up 50%, but you can multiply your capital significantly if you can be alert to some of those movements and those trends.
That's correct.
So that's the issue. The element of the technical analysis that it tells you. I mean, when IC Insider wrote in 2015, I think, September, thereabout, that the market was going to break out. It's not until April 2016, when Mayberry had some conference, that out of that conference came the message that the market was going to rally or something. But the rally started 3, 4, 5 months before. The signal was there 5 months before. So the average person only hear about the market when it hits the headline in some shape or form. That boy, the stock has gone up 50%, and that one 100%. But the seed and the genesis of it was laid months before. And the same thing applies to the main market. Main market is struggling now, but the indicators are that in a month or two, the golden cross is going to take hold. And you see, people are looking at P ratio of 20 and 25 in a number of cases and considering that high. As I said to the chairman of some listed companies last year, I think, or year before last, and he thought that he said that the the prices were overvalued. And I said, no. For one, many people are looking historically at what their earnings historically have been, rather than looking futuristically at what is likely to come. And I say, when you have interest rates, and you see the same situation in the States, where they talk about the average P ratio in the States of 15 or 20. But when you have a company that's growing profits at 50% per annum or 100% per annum, and interest rates are virtually zero, or let's call it 1%, a P ratio of 100 is not, if you believe that those interest rates are sustainable over some period of time, a number of years, then buying profits at 100 times earning is equivalent to putting your money in the bank. And well, it's better because if the profits are growing at 100% per annum, the profits are going to go up next year and the stock will keep on rising. So where we have interest rates in Jamaica with treasury bill rates under 1%, 20% for stock is a giveaway. And what people are likely to recognize in some years down the road is that a stock at 20 times earnings was probably best steal, because the P ratios, if the present economic conditions remain, where interest rates remain pretty low, you will find that what are the alternatives? Do you want to hold cash money and earn 2 or 3 or 4% or 5%, whatever the figure is, and be taxed on it? Or do you rather own in, we think, or use it as an example, that the profit may grow at 20% or 25% per annum and increasingly pay you more and more dividends each and every year? It's a no-brainer. So the choices are, do you go to real estate? So what one is going to find is that real estate prices are going to go through the roof, and likely become a social issue as more and more people are pushed further and further away from the center of economic activity to live further and further afield and wake up. Like if you live in New York, you take you 1 hour or 2 hours to get to work and 2 hours back because you live where you want to live.
Yeah, that's funny you're saying that, 'cause that conversation is actually very current, fresh right now, as in people are arguing online. Almost, see, I don't know if do you use your Twitter at all?
A little bit. I've seen 1 or 2 discussions on various things, but yeah.
But you don't really follow it up day to day?
No, I look at some of this stuff on some of the comments that some of the people I'm connected with have to say. So, but I don't have a lot of people in the thing that are stock market people. So I probably have to rely on my son-in-law to provide some.
And that's funny because there's an entire there's a lot of people, like almost the only thing I do online now, and I have a few thousand people that follow me, is stocks, and there's a bit of a community there, and the community pays keen attention to what you say.
Yes.
Yeah, you discuss all the time, but that's true. You don't have to be there to be discussed. It's a good point. But I mentioned Twitter because the conversation recently has been around exactly what you predicted. Housing prices and it becoming a social issue. Now, from our perspective, like I understand why it's happening. It's a business, a human thing. If I get a house right now, if I get an apartment in New Kingston right now, I'm not going to sell it for $10 million just to say I'm helping poor people. I'm going to try and get as much money that I can get personally from it, right? And the real issue is that housing is sold by person.
But if you sold it for $10 million to a poor person, that person is going to take it and sell it to
because he doesn't have to.
$40 million
immediately.
So the state has a responsibility to provide and be a referee for things, and at the same time we have to recognize. I mean, one of the unfortunate things about Kingston is that a lot of people want to live in Kingston, but we have half of Kingston that is dilapidated and the values are down because nobody has really taken enough wholesale basis to try and deal with the urban blight that exists in the country, so that we could create habitable space for many persons by tackling the problem, which is another problem that can be easily resolved. One of the recommendations which I'll make on your program, which I hope it goes forth, is that what we have done, we have distorted the system. We have created things like NHT that has heaped more cost on businesses, and they heap more cost because governments in the past felt that it was more important to pretend that they could help the poor by taxing the society excessively and doing things that the private sector should do, rather than allowing the system to self-balance.
Yes.
And then you provide the resources, social well-being, for what the system cannot deliver. The NHT should not be there to be delivering housing and mortgages for people who are in a position to go to the regular building societies and seek loans. What was important in the past is that the economic policies should have been geared to keeping interest rates and inflation and interest rates low, so that people could go to the traditional lending agencies to borrow. It's just ridiculous that when you look at the banks and on building societies, they are lending building society maybe 45% of the resources that they have, and banks maybe up to 60% at the moment. But you look at Trinidad, the last time I looked at the bank, they were lending 80-90% of the deposits that they had. So when you distort the system in that way, what you're doing, you're causing the people who borrow to be paying extra money for borrowing, because the banks need to make a certain level of return on investment, and they have to look to either cut the deposit rates and or hike the interest rates on loans. I mean, one of the ridiculous things that has happened in the country is that before we had the economic crisis, NCB had a credit card, and I think the interest rate was something like 18%.
Yeah,
rates went up to 60-odd%, and they have been stuck at 44%. And we have a minister, a person who was minister was a minister at the time, talking about bank charges, etc., where a lot of the people who are using credit cards and could probably use credit cards to help them considerably have found themselves into a major problem, because they're borrowing money at 4% interest per month, which is 70 or 80% per annum, and many of them cannot afford to support the credit cards, and some of them need it for emergency purposes. So those interest rates have remained stuck, although rates on normal loans are now down to 7 and 8%. It's just a crazy situation that exists in the country, and nobody is doing anything about it at all. Yeah, so there are lots of things in society that requires attention, probably by the government, and maybe in some cases the opposition, who can actually come forth and identify things that are just not in the interests of the country or the people in the country. Because what is going to happen, that those people who utilize those facilities become very despondent, and you run into the problem that United States have run into, where people, a certain group of persons who believe they have been disenfranchised, take it on themselves to try and right the wrong that they see. Right?
That's true. And the system, I always say, the system can never be beaten. That's the simple truth. Unless, the system can never be beaten. The most happening is that.
Yeah, but they can influence the system. They can influence the system, and we have to try and influence the system.
Yeah, and that's what it is. You can't beat the system. You have to change the system.
Yeah.
Yeah. Yeah, so that's, I mean, that's, you know what, I feel like I've committed, like, let's say, interview sin because we're so excited that we jumped straight into stocks with you, and I should have instead jumped into really you, who you are. So let me start with you. Who is John Jackson? I know it's like late, but we'll shift gears and we'll go there. Who is John Jackson really, the man? Who is John Jackson, the man that we know about?
Um, that's a good question. I I hate to talk about myself, and when I go to speak, I ask people to speak minimally about me.
Mhm.
Um, I'm just an ordinary Jamaican, and I am from a family that have some bright brothers and sisters. I don't necessarily particularly regard myself as bright. What I find is that I observe certain things, and there are things that I'm interested in, that intrigue me. And if I'm intrigued, I will go and find out a lot about those things. My family, like many, didn't have a lot of wealth, but they certainly had the understanding of the import of education. And if one gets educated, the world is open to us. And similar, my knowledge of investment, I've been drawn in. My first interest was agriculture. And I actually, in high school, I did agricultural science. Yes. So that was where my interest lied. And but eventually I morphed into accounting, and then into investment. And I've always loved investment. My first investment was 10 Bank of Nova Scotia shares, which I bought for £2 each at the time. And I think I doubled the money. Never knew anything about investment per se. I think one of the next stocks I bought was Montego Freeport. Bought it at 57, equivalent of 57 cents. I think I sold it at $1.50 something. Again, one didn't have lots of capital, so it's on paper. But I've always been intrigued by what stocks could do. And then in the 1980s, I started to write on stocks, and recognized ultimately that I didn't know as much as I thought I knew.
They said the Dunning-Kruger effect.
That's a big lesson, you know. I think it's one of the best lessons you can get.
Sorry?
I think that's one of the best lessons you can get.
Well, it forced me because the Gleaner invited me to start to write for them, and it forced me to do research into companies and research into economy and what have you. So I educated myself from then, and I unearthed a series of marvelous investments. Lascelles, Democado, Jamaica Flour Mills, and others that were just incredibly undervalued. And those were exposed to the general market, and the general market ultimately recognized the values that were there and drove them from nothing to something that was very incredible in value. So that, and it has forced me to continue to do research, which I like to do. I just love to do the research, examine financial statements, unearth nuggets that are there that the average person is not seeing. And you know, I'm intrigued to give you an example. The RGR, which stock that is now top 10, top 15. You know, they have gone ahead. They have cut costs. The latest results are out. The TV station segment of the market, the profits jumped considerably in the December quarter. Nearly $400 million segment results there, compared to to a much smaller amount the year before. And they cut some of the costs in the operation this year, which I estimate about 200 million, seems to be redundancy cost. Right now, when you move from that situation and recognize that, I just recognized this past week that, whoa, you have 2 new lottery companies. And one lottery company has had about six or 7 pages of ads in the paper. So that it means increased revenues for the Gleaner, and I presume for RGR itself, the TV station, TVJ, etc., because they are going to continue to be, when you have competition, whether it be liquor or those type of things, it just means increased spending.
All right, so we just come back from a small break. I think, John, before the break, you were telling us about
RGR.
And how you see it, and just picking up the gems. That's one of the example of a gem you said that you pulled out, and you noticed within your financials that you're making more profit now, and they did promise us a reorganization and a reworking of the group. And we've seen that. We've seen a new chairman come in, and we've seen the numbers improve since the latest results in the first quarter of 2021.
Yeah, but based on this history, it's not a lot of people are going to be focusing on because it has had
a rocky past,
recent past since the merger. But we have written in IC Insider about it. Some of the changes that have taken place and are taking place. But when somebody has actually cut cost out of an operation, significant cost, then you're probably looking at substantial jump in profits. And when you also take into consideration that last year was a terrible year for many businesses where they lost revenues, it means that going into a period where you ought not to have that level of revenue dislocation, and with low cost, you could be looking at a nice pickup in profits. And I believe it's one that is going to surprise a lot of people going forward. But you have to do the assessment, the analysis, and use some business skills to understand where some of these things, what the implications are for many of these companies, and look beyond just the current financial statements. Because if we can look beyond the current financial statements, we may see exciting multiple increase in profits and stock price. I mean, our Jamaican teas is a good relative example of that, where last year or year before last, we suffered from last year actually, suffered from the decline in the stock market and the impact that QWI performance had on the operations. But people seem to have partially, not totally, partially ignored the fact of the core entities in the group, plus the real estate development, which I think you guys spoke on an episode that I listened to.
So you listened to that?
A follower of mine, as I told Randy, he has been speaking to me about you guys wanted me to appear on the program, etc. So I actually listened to it and fast forward listening. And I
big up that listener. I'll keep it anonymous, but big up that listener.
And I was hearing the excitement you guys had about the stock split and the fact that QWI seemed to have been coming back from the grave, etc. So the opportunity to sometimes pick up little tidbits that gives you a wider picture into the future is sort of thing that I look for. In being I call myself a semi-journalist of sort. Sometimes somebody tells you, says, John, rain is falling, and that's it. That's all he says. and the rain falls heavily, maybe somebody who is taught in agriculture, the farm might be flooded and animals get killed, etc., etc. So you have to then take that little tidbit and put some interpretation on it, and do your homework to find out what is really happening in the marketplace.
Yeah, what we call it that. What I say a lot of is that I do a lot of dot connection. You have to connect the dots, yeah, man. And actually, actually started making that joke back when I give analysts a hard time because I think that typical analysts don't do a very good job of actual analysis and recommendation when it comes to local equities. That's my view. That there's a lot of room to improve. And I started making that observation when I was an analyst, not a analyst for the public, but I was a business analyst. And I used to make a joke that the typical analyst is a type that will go outside in the middle of a hurricane with a rain meter and come back inside and then tell you that, well, based on current trends, we predict 100 years of rain.
Yes.
And I'm saying, yes, of course, the rain meter is full, but you have to factor in the fact that you went outside in the middle of a hurricane.
Well, not in the center when the calm is, and not in the eye of the hurricane.
The eye of the storm, exactly. Because the same analyst will go to the middle of the eye and tell you that, listen, the storm is gone. No, yeah. And hearing you say these things in another way has really, impacted us, because Danhai and I, we've been talking about this stuff for years, and the response has not always been good. And I know, I know, just based on some of the responses I have gotten publicly and privately, that you must have faced a lot of the same thing, because it's one thing I realize for all these stories we've heard, is that when you are literally setting a trend or doing something that you know is right, very often it's not going to be accepted by the masses at first.
Well, my theory, Butch Stewart passed the other day, and may God bless his soul. But I had the temerity when he had initiated the dollar, the Save the Dollar initiative to oppose it. In retrospect, I probably didn't oppose it. If I were approaching it now, I would approach it somewhat differently, but I would still have opposed it, because situation was even worse, because they never dealt with the fundamental issue that was required to sustain the value of the currency. So the government kept on with its reckless spending, heavy fiscal deficit at the time, etc., etc. That just undermined the possibility of the dollar could have been kept. And I said to my wife, I said, man must have been a brave or stupid man. They had this session upstairs of the Pegasus on the top floor. And I felt that, boy, they could have thrown me off, and Butch Stewart was one of the speakers. That night. I was the only one who said it made no sense. But one of the things that I said to people, if you don't want people to throw stones in your direction, don't go to the public domain. And I've always had a desire. And when I was younger, studying accounting, I wanted to thought I'd become a politician. But I recognized my upbringing was one where lies, you don't tell lies, you don't curse, you don't do terrible things. And I recognized that, at least that's what I tell myself. And I see evidence of it in the United States at the moment, where people are burying their own personal conviction in the interest of a mafia-type operation. And I was never brought up in that. And I've always set myself apart from the crowd. And I'll do what I believe is the right thing to do, as opposed to doing what I believe people want me to do. And that's their examples set by my parents, not maybe in exactly the same way, but in how they undertook they lived their lives, and that's some of the elements. So I will say what I want to say, and I've learned over the years to modify how I say some of the things I want to say. So it's not as offensive as it would have been when I was much younger. But I do what I have to do. I've been blessed in having an accounting qualification. I've worked at KPMG, one of the leading accounting firms in this country, and I had a long interest in stocks, and therefore and I've written about stocks for a prolonged period of time, and the economy, and therefore I've gleaned certain things as a result of the analysis, and I still keep on learning more and more. It never ends. It's just an exciting, incredible learning experience that I wish every single Jamaican could participate in, because there's a rich reward for those of us who take on that type of endeavor. So I'm not worried about. I mean, I critique. I remember, and if you did a research on IC Insider, you'll see where we'd written an article, I think in 2017 or thereabout, or 2018, where a major investment house was recommended that people sell Burrito in the September or thereabout of that year. And we were recommending at the same time that people buy Burrito because it was undervalued. So their recommendation, sell it at $3 because it was worth more than $2. And we were saying, in fact, I had the good fortune of recommending to a person who worked at that same brokerage house a basket of stocks, and one of them was actually Burrito. Now, after she must have bought it, she said to me, but John, tell me why you say Burrito? So I presume she meant in giving the auditor broker, the mother said, but why are you buying Burritos? So I said, just buy the stock, put it in your suitcase, put it at the bottom of the suitcase, don't look at it for a number of years. And when you do look at it, you'll be very happy. Right? So so one can stand in line with where the crowd is, or one can do what you're convinced, and your training especially, it tells you is in fact what appears to be the correct measure, and you just stick with it. Sometimes you make mistakes, but invariably if you keep on plugging at it, you'll be right. And just move on.
Yeah, I like that.
Each person has to do their own thing, and we will comment on various things from time to time, but we can learn from others to see what people are not looking at. Because one of the beautiful things about investment, if broker A say don't buy the stock, and broker C don't buy the stock, and one broker buy the stock, and you can look at it and see what the rationale is. Therefore, okay, you might have to wait a little longer for the payoff. Once you have done enough homework to tell you what the factors are, it just happened that in the case of Burrito, because of how the company was managed, and you guys on the podcast that I listened to, you recognize the virtue of trying to satisfy shareholders. Many managers or management believe that their sole responsibility is to the bottom line of the company. As far as I'm concerned, my responsibility is to the bottom line of all stakeholders, right? And a factor that is of import in the Jamaican scenario, I compared Trinidad, for example. Trinidad at one stage was trading more stocks than we are, but they have done nothing for their shareholders. Right?
Which is why their market is, I think in my view, that's part of why the market is so dead.
I didn't get that.
I think part of my view is that that's a huge part of why the market is so stagnant, so dead.
It is because
there's so much.
you keep individual investors out of the market by having stocks that are overpriced. I mean, when you look at it, the GDP per capita of Jamaica is, I don't know, call it 6, 7, 8 or whatever it is. Trinidad might be 15 or whatever. It might be 2, it might be 3 times.
Yeah.
But you have a typical stock in Jamaica, NCB selling at $8.50 TT dollars. In Jamaica, it's 130. $8.50 is $160 Jamaican or something, somewhere in that region, 160, 170. So the typical stock in Jamaica at that price, people find it challenging to be attracted to it. And NCB is one of the cheapest stocks in Trinidad. Republic Bank sells for $134, $140, 140 TT dollars.
Really?
So multiply that, nearly 3,000 Jamaican dollars. And normally stocks are selling in what would be the equivalent of 1,000 Jamaican. And only a few shares are sold yesterday, 300, 400,000 shares were traded in the market. So that people are not interested in providing all investors with the best value. I mean, the United States, people are used to stocks at $1,000 and $2,000 and $3,000. But Apple split the stock from $400 or they're about to $100, and the market was happy about it. They drove the stock price up. And they did the same thing with Tesla and those things. So it just tells you that in any market, there's a price that people don't find the average person is not going to find attractive.
Correct. Nominal value.
Right. And therefore, you pay dividends. If the market loves stock splits and you want to have also liquidity for the market, because what Jamaican Tea's move has done is to create liquidity. I might be wrong, and I don't have the physical record, but I can't remember Jamaica Tea's having the level of liquidity that we have seen in the last 2-3 months.
Yeah. A lot of investors are rallying to JAMT.
Sorry?
Yeah. It's a very low stock right now.
Well, I mean, the performance. Be careful of that chart with that thing that is not adjusted. I don't know why the stock exchange don't.
Well, this chart is specifically. This is my chart. It's using the stock exchange data. This is my chart, and it is adjusted to show you split correctly. But it's done this way for me deliberately because I want to. This orange line is the stock split, and so the volumes down here. You are correct. The volumes down here are much stronger since announcement of the split.
Yes.
ATM and the actual split, we have seen much stronger volumes almost daily coming out of JAMT.
Yeah.
And that's a question that people always ask, as to why do a stock split? Why are they doing a stock split? And usually the given reason is liquidity. But I think what people think is almost that you're going to do a stock split and then suddenly sell off all of your shares. That's not what it is. It's to give you, at least my view is that it's to give investors an option to be able to sell a fraction of their shares.
Compartmentalize the shares easier that way.
Yeah.
Well, the way I look at it is that, from my perspective, and I've come to the conclusion that a junior market company ideally should have at least 2 billion shares, 2 to 3 billion shares in the marketplace to provide a certain amount of liquidity.
Really?
So if the stock is undervalued, then and the investing public likes it, and that's one way to actually drive the price forward.
So should we take from that then the inference that until like 2 to 3 billion shares and Bitcoin is currently just at half a billion?
Sorry, I didn't get that.
I just saying, should we then take from that? You're saying that you think ideally a junior market company should have 2 to 3 billion units.
Yes.
Should we take from that then a little inference because Bitcoin only has half a billion units, 500 million?
Yes.
500.
Well,
So
the fact of the matter is, all things being equal, I don't know if Jetkin is yet at that level for that amount of shares. I mean, see, you could, but that wasn't their problem, and they are more recently listed. In the case of Jamaica Teas, it's listed some time ago, and so but $1 billion to $2.5 billion. If you look at what has happened to LASCO is one of those groups that tend to trade fairly frequently, and it came about because of the, because when you have 1 billion shares and you issued 200 million shares to the public, that are relatively small in value, you get the top 10 people control 99. I mean, take a company like ISP. The top 10 companies control 97 or 98% of the stock.
Yes, there's not much trading going on in that, and you can see the ISP's movement. You can see with the big jump upwards and downwards because liquidity.
Right.
Liquidity premium on it, basically.
Yeah.
I mean, start of the year, ISP has traded twice.
Yeah, and look at that jump.
So the point is that one needs to recognize, if I were at ISP, I would have stopped long ago. Right? Yeah. And I would have recommended, because as chairman or director, one has theoretically one vote, but one can use one influence. So
you can only go so far.
Right? And in the case of Jamaica Teas, we have had 3 stock split so far.
You have,
right? And it has paid off richly.
As into JAMT, I think we can drill into that, because we have learned to recognize, at least for me, we learned to recognize the John Jackson companies, the John Jackson group that moves, like JAMTs and then QWI on the JAMTs. I don't know if I have this right, but we're probably most excited about JAMT currently. So we're seeing. I don't even know how to ask this question, Dice. I'll ask the answer how you can. I mean, what's next for JAMTs? Can we see? I mean, you guys have no need to stay on the junior market now, and I personally think that you have some need to go to the main market because it allows you to raise. We've seen a lot of your export improvement, manufacturing is a chance, and aging out of have aged out of the tax break. I think from October 2020. That's right.
It was June or July.
June or July. Okay, so you're aging out of it, or have aged out of it already? Correct.
Yes.
So there is no need to remain on the junior unless you plan to do, which I've also heard rumored by you guys, a spin-off of your arms, or maybe your manufacturing arm. I noticed some things happening with the supermarket arm also. So I don't know, what can you tell us about that? What are you seeing with regards to JAMT? What is the overall view towards JAMT? Why should I keep buying more? Because I have a lot. Why should I keep buying more?
The scenario as it stands currently is one that we don't have to go to the main market, and we don't have to stay on the junior market. The options, and we have discussed it in the past. We have just delayed because there's a lot of discussions within the group currently as to various things, but what's happening, the opportunities that could possibly crop up, like in 2021 with some companies under pressure, etc. We don't need to go to the market for capital under normal circumstances because we are net generator of capital. So we have limited borrowings. So it is the ultimate question as to whether one stays or don't. I think is going to be predicated on what is probably best for the company and for shareholders. And I think probably before the end of the year, if we are to move, one will hear. So but there are a number. You raise the issue of a spin-off, and that I think John Mahfood had spoke to publicly. It's something that we have deliberated on. But as I say, there are a number of things in the mix that we have to, we as a group, we have to sit down and determine what it is that we want to do and the time frame that we want to do them in. But it's a dynamic environment. We have the factory expansion that we have to deal with. We're dealing with. We're starting a new apartment complex. It's going to be pretty dynamic. There are, the investment side. I believe there are opportunities down the road to really expand in that area. All things being equal, so it is, I think, going to be an interesting period ahead of us. So, I can't tell you whether profits will be better or worse off of them. I would hope that what steps we do would be reflective of what we have done in the past, and hopefully we'll. I mean, I'm not a member of the family, but my company and myself, we own a few shares in it, and we have options, or I have options. That the better the stock price does, the better it will be, hopefully, for myself, so and my family. So that the objective is really to continue to build the operation and build it into a profitable, attractive enterprise that will keep on adding value. I mean, if you look at the annual report that is not out, but I think it was on the website, you'll see where there's some graph in the Jamaica Teas thing where, what has happened to profits, what has happened to equity over time, and it keeps on looking up and up. And I believe the investment arm is going to contribute considerably. You asked a question, my thoughts on the environment currently, and the reality is that when you look historically at the market, our market tends to go through a period of, I thought it was 6 years. I went back and looked at it, and I'm finding it's more like 8 or 10 years. But I guess in a robust bull market run, it's probably about 5 or 6 years. And so we have had a break. So, and we have had a break, and the market pulled back considerably. So I believe with the environment that exists now, we should be looking at I would expect a fairly decent run of years, and the whole economic policies of the country. I mean, if we can overcome the ravages on the economy of the pandemic, then it means that things can get back to some level of normality. Hopefully tourism can come back roaring, and financially, fiscally, we can sort ourselves out. If all that happens, and the pilot of the plane keeps the flights relatively smooth, then what one should be seeing is relatively low inflation, relatively low interest rates. And incidentally, the Bank of Jamaica's target is, I regard it as, but the only logic I see for it is really to be a part of the equation to reduce the debt to GDP ratio, because there's no other reason that logical reason one could put forth to why we would want to target 4 to 6% per annum, when the logic suggests you should be looking at maybe 2 to 3% inflation per year. So that the environment is conducive, generally speaking, to continued growth in equity values. We've seen a significant growth in a number of players who have come to the market with the launch of some of the recent IPOs in the last 2-3 years. I believe that growth is going to continue once newer people can make money and see the opportunities are there. They will tell their children, and the children will tell their children and their neighbor and so forth, and bring more people to the marketplace. My major concern, however, is the number of APOs and IPOs that might come to market and drain the market of some level of liquidity and create stagnation in the secondary market. So that's an area one to look at. But I see recovery in a number of companies. In the main event, the express catering, the tourism things, and we can get back to some level of normality. Those prices have been knocked down. CPG, that's Caribbean producers. So JetCon, our companies have suffered significantly from the pandemic, and others that if things normalize, they could be candidates for multiple appreciation in stock prices.
But in the meantime, like you say, you are really driving your part of the ship to ensure that however things work out, you win, because even though things haven't quite recovered yet, we see, bringing it back to JAMT, and I mentioned JAMT and QWI because QWI is essentially the investment arm of JAMT, as I see it. And you have positioned it in such a way that over the last 3 quarters, you've really been heading back into profit. We saw, after you have hit NAV for the first time in, I think, ever. Is that right?
Share price.
Repeat the NAV question.
You got close to NAV. So where we're talking to you, let me make sure I have it.
NAV is now 125 as of Friday.
And the price is?
So it keeps on rising. One of the things, and I guess people have come to the party a little bit late, but the
share price has also, for the first time, gotten very close to it. 117 is probably the closest we've seen it get to one.
Well, it traded as high as 126 during the course of the week.
Yes.
Right, so it went as high as 126. So that at one stage, and somebody came in and sold. The truth be told is that if you are of the view that the NAV will continue to rise appreciably, then those people are not. If I were not an investor in it, then and I wanted a fair amount, I would have little question in buying at a premium to the NAV. Right, because in our top 15 forecast, we have the NAV, not the NAV, the stock price going to about $1.80, which would be 100% year-over-year growth.
That's a strong thing. I see you've been driven heavily, or you took so many little things. You've been driven heavily also by the US market, which you've been playing in. Well, let me never go to US. Let me do the top 10. So we pay close attention to you. So I keep, this is as much as we can. This is your top 10 holdings as at December 31st, 2020. Holdings. So I mean, you can maybe be able to see much detail the people watching, but we see the direction of this line. It is consistently up. You continue to grow. I'm on record, I should say, as saying that you guys took on the albatross of Access Financial. But obviously, if you believe in the long-term viability of a company, being able to take a stake that early and that large, it might be frowned on now, but in 5 years, it might neither be here nor there.
Well, I believe in a medium term. I see. I mean, the Access December results, although 20 odd cents, is better than the September quarter. The revenues are higher than the September quarter. The loan figure is higher than the loans at the end of September. So they have taken significant provisioning for loan losses, some of which they are recovering. So basically what they need to do is to get back to the stage of growing the top line, and which apparently have started, and they'll be okay. Again, many investors just focus on the wrong thing, because we have NCB in the portfolio. We had Grace in the portfolio for some time, and Grace didn't perform. Yes, it's not the same size as Access, but we have had BNS. So there are a number of stocks in the portfolio that have not delivered in the last period of time. But we have seen growth of others. So our Grace has started to move, and I think it will move up substantially during the course of the year. We bought Jamaica Teas, and people didn't want it at $4. We bought a block of them at $4, or $4 a little bit, and that is almost has gone up 70% since then. We bought Mail back at under $2. We bought Lumber Depot under $2. So we think we have done a number of moves. Our overseas portfolio is split in two. One of it is handled by the broker, smaller portion. His last time I checked on it, his portfolio had almost doubled within less than a year.
Because you have here, we also track that. So again, just the top 10 that you told us. That's what people be seeing here. So you have from Alphabet, Google, Home Depot, Nvidia, and those are doing what I'm seeing literally just on the day-to-day. So these numbers aren't instructive for the whole period. Just on the day-to-day, we're seeing 4 downs. But my own knowledge of the US market is that you are well set in terms of things that are pandemic, not even pandemic proof, pandemic boosted. You know, everybody's at home and online. No Google so more. People at home doing more home work from home, picks up the house. Home Depot has been continuing to rise. Nvidia, Danhai and I had a long conversation about Nvidia and AMD, because both of those, they made those small chips that we need in our phones, we use the PlayStation 5.
And more and more they're being bought into stuff.
Actually, a heavy shortage in the chip market, and has been for the last 6 months. So when I say Nvidia and AMD holdings, I'm happy about that. I don't have to sell anybody on Amazon. I don't have to sell anybody on IB. I don't have to sell anybody on Apple. I think maybe the only one would be Thermo Fisher that jumped out to me as a buy.
So you know, the things are that side of the portfolio has done well. The Jamaica side is coming back. The Access, again, you come back to the one matter. If you have one stock is 10% of your portfolio, then you don't. I think it's probably less than 10% now. You don't have to worry yourself unduly about it. I mean, you want it to perform, but in the very nature of stocks, one of the reasons why you diversify, you're hoping that your selections will pan out in the final analysis. What has essentially happened to the entire financial service sector is that the pandemic knocked out a lot of the bottom. So had it not been for that, Access would not be at $21 now. It would be at a higher price. And the same thing would apply to NCB and Scotiabank. And Lasco Financial Services, it got hurt. It's now the last results are positive, very positive and pointing in the right direction. So so a 10% holding is not going to necessarily hold down your performance unless it falls sharply. Yes, if it moves up, because what happens is that it's 1 cent is equivalent to about, well, it depends because your things are rounded up, but between let's say 9 million Jamaican dollars and 9 and maybe 18 million Jamaican dollars would probably equate to a 1 cent movement in the NAV. It's going to vary from as the value increases.
And as a whole,
It's roughly about $13 million is equivalent to a cent in the movement in the market. So if like Jamaica Teas we have 30 million or 30 odd million shares in it, if it moves like it moved during the course of the week, maybe 50 cents, that alone is probably 1 cent added to the portfolio. So, while Access is something like 8 or 9 million shares. So if it moves up at the same level or down at the same level, it doesn't have the same impact.
It's a bit because your JAMT, the gain so far in JAMT, at least for this quarter.
Sorry?
I think you've hedged the bets pretty well because the gain so far in JAMT just for this quarter is enough to offset any fall in Access, at least at this point that we're speaking. You've seen a 37 million rise on the value of JAMT at the point that we're talking. And that 23 million fall in Access. But again, that's a hedged bet, and that's the sort of thing I would want to see if I'm managing a whole portfolio of things with multiple moving parts, and I have to think in both the near term and the long term. So,
I'm not sure I'm following totally. One of the things that I'm going to give you an answer, which may not be the answer that you're seeking. One of the things about portfolios, like unit trusts and ourselves, is that once you have made the loss, you have made the loss, and you revalue the assets from day one. So it's not the fact that you bought it at $32 and it's now at 20. Once you have recognized that loss, that's in the past. And you start from day one.
Exactly.
With $20 or whatever it is. And we have to bear that in mind. So yes, if it doesn't perform, it has a negative impact, or it slows down the movement in the growth in the net asset value. But in the final analysis, if we have the net asset value has moved from 106 at the end of September to 125 today, which is quite 20% or whatever the percentage is.
18%.
How much?
18% growth. 18.9.
Yeah, okay, nearly 20%. So and that's just 2 months. Sorry, that's since then. So we are just 4.5 months into the new year. So that's equivalent to 80% for a full year if the trend continues. So we'd have moved from a $1.06 to $2.12 at the end of the calendar year, if that trend, or fiscal year, calendar, whatever it is, that trend were to continue. So we'd have actually surpassed our highest net asset value ever.
Yes.
By some degree. And if we keep, if you do that and keep on growing it, then at roughly the same pace, by next year, we're at $3 or somewhere in that vicinity. So, and maybe at that time, Access will come back, and Access may well come back with roaring and add even more oomph to the performance.
Definitely.
Yeah, I suspect that would happen. What I was showing was, because you see, you have a different view from us on the inside. So what we are doing, what I do here is I literally just watch it each quarter. You are actually, as from my internal view, and obviously you would also know the intra buys that you'd have done from the start of the quarter to now. But from my view, I am seeing an overall, the top 10 elements in the portfolio, at least the JMT side of it, is already up to 6.6%, which is an extra 61.5 million. So that's what I was looking at and saying that even at this point, if Access goes down, everything else is more than cushioning it. So you're well ahead.
Yeah.
Yeah, I was calculating based on what you see had in JAMT at the end of December 2020, and what that amount is worth currently. is worth $37.8 million more currently than it was at the end of December, and the access
Okay.
is worth 23 million less. So I'm saying the JAMT is more than hedging against anything in the access. And we still have another 32 million from GK, another 32 million from Mailpack. And those three things, I mentioned all three of those stocks no, because, and I'll also throw Carib Cement in there, because I'm also expecting great movement from all four of those things for various reasons. You know, Mailpack has strong business that they've been seeing since listing and for last year. And GK, I think, is about to surprise a lot of people with a lot of moves. We see them going to the M&A activity over the last few months. They bought Key Insurance, which we made quite a bit of money off on that one. Value ahead of time because all the value that was found and seen there was, you have to look at the business and understand what's happening in the business and then
Yes.
check ahead. And Key's past performance is not a good basis to project from, because who Key was 2 years ago is not who Key Insurance is now.
That's correct.
Yeah, and so that allowed me to and as a great, let's get pissed off a lot of people for some reason, me seeing and saying it, but we have seen where the share price, I was buying it at $1, $2, $3. It went all the way up to $8, $9. We benefited from that. Rights issue benefited from that. I'm still benefiting from that, and they're about to report now, and I suspect they're going to report either profits or the
last time.
A reduced loss.
Yeah, because the last year in this quarter, the quarter that reporting now is terrible. It was 400 and something million in the one quarter, and but come out of the trade for the months. That's also good.
Exactly. I have some PCLs to write back. Who know? GK themselves have been making some crazy moves. I wouldn't be surprised if they buy another company very quickly, another listed company or two very quickly.
And remittance is just working in their favor right now. Yeah,
remittances, that heavy spike in remittance has helped them. Reorganization of their food business has helped them. I've been looking at them and CPJ heavily. I wouldn't be surprised if they buy CPJ. CPJ has been bleeding.
Again, that's not going to happen, but there might be elements of cooperation between the two parties.
Because they've been working together on a few projects, and really and truly, CPJ don't have much choice today.
Well, they have choices, but you can rationalize some aspect of the operation if you think it's beneficial.
Okay, it's not like you're definitely not saying something.
Well, I don't have all of the things, but my understanding, as you said, that they're incorporating some elements of it. It's not an impossibility. Sometimes things are there and people are not talking, and suddenly, people find that overnight there may be opportunities that never really focus on, and people change their mind.
I get you. Well, either way you do, GK is in a great space, and you have a strong holding in them, and they are probably one of the most undervalued stocks on the exchange currently on a PE basis anyway.
Yeah, but one of the things that we have to, just a small point, what you will find, and it may not have existed so much in the December quarter, and it probably the offers on access, the offer prices have actually declined for some large amounts. They were at $26, $27 some months ago. We are now at $24, $25. And what used to happen is that, and it's not just access, it happens to, there's a window dressing scenario that takes place at the end of the month, every month. And when you compare, for example, so our quarterly results would reflect values, in some cases inflated, because the bids and the offers are adjusted, or the last prices are there's some adjustments at the end of the quarter, end of the month, that you see in stock prices. And therefore, you see in the case of Access values will spike $2-3 at the end of the month. And as a result of that, you will compute and say, well, next mid-month, the values have actually gone down by $20-30 million. Yes, that's so, but it really hasn't changed very much from what it has been for the last several months. And yes, it might, the end of month move might help the NAV, but ultimately, investment is not a short-term thing. It's I mean, sometimes it is, but when you hold millions of dollars of shares, it's oftentimes a longer-term, medium-term endeavor, and one has to focus on some of those things. So once you have the investment, the question one has to ask oneself, should you get out of it if it's not likely to perform very well in the short term, or do you hold it? And the problem with an Access, if you get out of it when things turn around, it's not like an NCB or Scotia or even Grace Kennedy, where you can come in. I want to use Grace, but Scotia or NCB, where the liquidity is such that you could come in and get a fair amount, or you can source it more easily. But there's no reason why Access earnings should not get back into the $3 to $4 region within a year or two, all things being equal.
Of course, and that's what I'm saying. You have to. We have, a lot of retail investors listening to the show, but we have to make allowances for the fact that you are not necessarily managing things as a retail investor. You have to. Yeah, you have to have a basket of goods that you manage properly. And with that point, it's good. I'd like to know, how do you feel about the retail investment rise?
Before you go to the retail investment, because one of the things that you want us to bear in mind, I'm the chairman of the investment committee, and I'm following the stock market both locally and overseas on a daily basis. But even then, the way things are, that even the local market has 100 odd listings. The way the platform is, it's not as easy to observe trading the way it was. The NASDAQ system comes with a lot of benefits, it's stable, but it's not a platform for observers. You're only lucky to see your trade has gone through. Other ones, it would have a light up, you could set up, you could light up, you could see, you can look back at what the last trade was easily. This one, it's just not possible. So it comes with a lot of advantages, a lot of disadvantages for observers. And then I can't set up a platform, I can't set up a things for, I guess the favorite you can set up, but there are limitations. So in the whole platform, I had a junior market screen and a main market screen. So it's easy to flip between one and the other. I'm not getting a sense that when you set it up, there are disadvantages. If I click on a thing in my favorite and somehow it accidentally clicks remove, you have to reload it. Not just reloading it, I have it in a certain order. So if it's a junior market thing which is on the top of my list, and I delete it, I have to go through a long, tedious process to get it back into the place that it should be. So it's not it needs to be some work done on it so people can see what in the whole system has a streaming thing that show you what stocks are traded or whatever. This one doesn't provide that type of nicety. So it makes it so things are happening, you're not even aware of it, although you're supposed to be observing the market. US markets are big markets, so unless you have the stock as highlighted to watch it. You just can't pay unless you tell the thing to give you send you an alert if something particular has happened. So it's and therefore that restricts you in some of the things you can do. Our investment committee, generally speaking, meet once per week, and in between we may if something happens, we confer with each other and may make a decision. But it's as an individual. Well, it's like an individual. They watch the market after the market closes and say, all right, the stock has gone up. Maybe it's close to where I want to sell. Let me sell. So there are some of those restrictions that exist in when you can move. I say the whole matter of getting volumes in certain stocks when you want to get it, when you think it's the time to pounce, opportunities may not always present itself. So even some of the stocks that are like Alaska and if you want to get it at the price, you want to get it at, because you might be able to get this volume. The question, can you get it at the price that you find advantageous to you?
I get you. And that's a real thing that you bring up there with the platforms affecting you. You'd have seen so much of the platforms change over the years. Even Danhai, I tell Danhai, like, just certain problems never existed when even I started, right? And as we've gotten new features, we've gotten new problems. I learned the circuit breaker rule, and it was a very clear thing to me when I started. Circuit breaker rule has grown and grown and grown and grown to the point now where I wonder if and I'm not sure if it serves the purpose it should anymore.
It doesn't serve any purpose. There's not one. Nobody can point me to. Let me give you an example of how useless the circuit breaker is. Cement company put out their September results towards the end of October. Big jump in profits.
Yeah, huge.
That normally, I remember when the results out, I'll get my Gleaner or Observer to see. But it happened that week that I just didn't remember. So when I opened my platform, I saw the bid up at $50 I said, something has happened. And then it dawned on me that they put out the results. So I got the paper and looked at it, and so it was. And I immediately wrote an article on the results and released it through trading. And the stock was frozen because of the move in the price on the Monday. And so you'd have thought that's a logical situation where a price has gone over 15%. That they would get information to the investors. And those results never came to the market until either the Wednesday or the Thursday.
Yeah. As you said, Cement, those of you listening who pay attention to the market would know, Cement often releases the results, and you can get it on their website. Sometimes you can get it on the Trinity market. You can get it all over. And then oftentimes days later, it's on the JSE.
Right, so the information is not in the public domain, and you stop the stock trading for 1 hour, presumably to get information to tell you why the stock has jumped. And yet the market, the investors don't know.
No change. The whole point of the stock never make any sense. Why?
Right? So the other factor is that even if you want the circuit breaker rule to be there, there's no need to freeze the stock from trading for an hour. And what it does in the last hour of trading, if you freeze it at midday or 11:59, you can't trade again for the day. It doesn't make any sense in a small country where information, I mean, in my days, you didn't have, the early days, you had telephone. And so if you wanted to get a message, you have to get to a landline to call somebody to get information, right? And then it morphed into one in which, before digital came, some people had cell phones, some people didn't have cell phone, right? So, and of course you had fax, right? Now, information can go relatively, You see, part of the problem is, I mean, one of the issues I have, if you went back to the junior market report on the stock exchange, then you can pull it up. For about 3 months, they were claiming, not on my one, the Jamaica Stock Exchange, they were saying that 40 stocks, junior market stocks, traded every single day. Right?
Oh,
So if you go back sometime in December or
you mean
November,
the market report?
the market
Yes.
summary
Yes,
report was saying 40 securities traded, and it was consistently 40 every day. And I think you have 40 or 41 ordinary shares listed on that market, right? And nobody pays any attention to it. You know, we have a situation where I use the trading data on a daily basis and update reports. And some days, there's one day this week where can't remember which company traded, Scotia Group. It traded, they said they traded like 60, well, the actual NASDAQ said 62,000 shares. In actual fact, it was 80,000 shares or something. So, and so you get those ugly disparities taking place, and one is not getting the sense that there is that quality control that ought to be there to spot these things and make sure. So, okay, fine, your system throws up errors, but at least you'd expect to see some note being put on the website to say, listen, we're having some problems with these things, bear with us until we get them fixed. There's no such message, nothing. And that's not the way to operate markets. People need to, if something is wrong, you need to try and identify and tell people what is wrong, and that's being worked on.
I agree with you. Something that I've also we've brought up many times on this, and I think it steps on a couple of toes when you do it. At least when we do it, I can tell you personally, I have been told that it steps on toes because I've pointed out those things. But my thing is that, listen, it's not a friend thing or a job. It is, at the end of the day, this is like people's money. Like, I have either lost money or not made money because of poor information or a rule that has changed and nobody tell the public it changed. Just change.
Yeah, but part of management is that you need to look at, you create rules and you re-examine them. I mean, you know, look at what has happened in the United States at the moment. I mean, what has taken place over the last 4 years dictate that some people who are sufficiently alert and concerned, if they are in a position to, will change the rules. So some of the things that have happened, you minimize because you can no longer rely on the integrity of people the way it was some years ago to do the right things. And if we, the truth of the matter is that Jamaica is the foremost capital market in the Caribbean, if I may say so. And if you want to build a system and have integrity, we want foreigners to invest in the system. There's so many things that are not right with our system. You know, you have players creating agreements and breaching the agreements, and all sorts of things taking place, and it's as if there's no recourse. But I wouldn't say there's no recourse, but we can't build a system where you are forcing people to be fighting constantly to for the right things to be done. You know, the minister spoke to the issue of APOs and things being marketed like lollipops or whatever. I'm not sure that's how they market lollipops, but I say more like ice cream or whatever. But I was going to write an article, which I probably still will write if I get the time to, is that the trustees in bankruptcy have taken control over CMP Industries. because CMP Industries, the majority shares were bought by Cash Plus, the people who owned Cash Plus or Cash Plus operations. And that has gone on for how many years? And shareholders have not had, there's no AGM, which is in breach of the Companies Act. There's no financial statements, which is in breach of the Companies Act. And nobody, the company is a profitable company and it has outside shareholders. And these people have taken control over the entity and don't provide the investing public or the shareholders with relevant information. It was profitable. Nobody knows what has happened to the profits of the company. Nobody knows what has happened to the cash resources of the company. Has the trustees in bankruptcy taken all the money, which doesn't belong to them? So Minister Clark is right, but he needs to also ensure that his house is in order. The government entity we can't have a government, we ought not to have a government entity that is in violation of the law.
Agreed.
And they said this is CMP Industries?
CMP Industries, right? The trustees in bankruptcy has it. And no shareholders, I mean, it was listed on the market prior to it being delisted back in the 1990s. So, or the 2000 period, whatever it was. Profitable, own property on Marcus Garvey Drive says rented out. Shareholders can't get the information. We have Goodyear that was being liquidated. Goodyear, the liquidators had the money in current account. And up to now, people can't get final payment out of the liquidation, and the money was in cash. So there's a lot that needs to be done with the industry, and there's not sufficient attention being paid to sorting out some of the mess that exists.
I agree, and I think I'm seeing a lot of the effects of almost you need to have the crowd or understand why something is important. Because when I started talking publicly about it, I tell people, listen, things should be better, blah, blah, and it sounds very good and what you're saying makes sense. But if a man or a woman listening doesn't see how it affects them, they probably just ignore it. So like when I used to complain about getting proper advice from your advisors, getting analysis, proper strong analysis and recommendation, as compared to people who are not investing. So they don't, what you're saying, but it doesn't sound good, right? Now that a lot more people have started to do it, they've realized that, wait, so who is the person that's out here telling me about it? Who is the person advising me? And they've started to see what you're pointing out and what I think Minister Clark was talking to. It's a real issue that I think it's going to take a couple of maybe companies having, I think a couple of lawsuits going to have to happen. Let's be clear. I think a couple of lawsuits are going to have to happen. And then you'll see people start fixing up. You'll see people start pulling together. And it's obvious across the board, and not casting aspersions on any one thing, but we've said it to other people. I say to you that we can tell when there's a John Jackson company, because one, the number's not hard to go through. It's a very clear format.
It's almost like if you get the feel out of companies that they're not talking to their shareholders, like if you're not a minority, if you're not one of the top shareholders, then it don't really matter. We're used to a certain standard from the companies that you're attached to, and I think that's largely because you're an investor yourself, so you know what you want to see in a report. Other companies, they really seem to cater to the people that listed it, the original owners of the company, so you're not really getting certain information. So like you feel like there's something like asymmetry. If you're not in the company, you're not understanding it as well, just by looking at the financials of the company.
What I would say, you're probably correct, but one of the things comments I would make is that I've seen over the years that some of the things that when I use we, not necessarily meaning Jamaica Teas, some of the things that have come to the market in terms of information or style, I've seen a number of companies adopting them. So I see, if you look at Jamaica Teas, we try and give you some analysis of the financial, the balance sheet, the P&L. Simple analysis, but it saves the investor from having to go and take a calculator and try and do calculations. And I see where, so we talk of the income statement, we speak to the balance sheet and some of the items or statement of financial position, and try to give people some sense as to what some of the major movements, what caused some of the major movements in the, and that especially coming because of my own personal in analyzing financial statements. You know, it would be nice if you see something out of the ordinary happening, that the management who has more knowledge or more intimate with the data could provide you with answers, rather than if you have to take up a telephone call and call them and find out why is this so, or wait till you go to an AGM or something of this sort to get those answers. So yes, I've put some of my own personal idiosyncrasies into those reports, and influence them in quite some way, where possible, and hopefully it is setting a standard that, you know, others can see the example and try and contribute. And I've seen it. I see Honeybun, if my memory right, showing improved commentary in some instances and so on and so forth. So I was talking to Jason Morris the other day and about his report, signals, and what is indicating that, you know, that they have tried to give investors a lot of information so they can digest it and get an understanding as to what's happening and where they're going.
Yeah, and that works. And it's funny enough, Danhai and I have spoken about Cygnus on this show many times, because we say that Cygnus is one of the few companies whose MD&A, the management discussion and analysis, is actually useful to us.
Right.
Yeah, as in we actually read it and it provides context. Yours things do it. No, my personal method is I read the MD&A last. I go through the financials first. I get my own view, and then I read the MD&A to hear what the company is saying about these numbers.
Well, that you have copied my style, because I tend not to want to go to somebody giving me. I mean, one of the things, if you look at my Jamaica Teas or whatever report, the typical director's report start off, directors are pleased to present.
Yes.
The thing there, and I'm saying, but why am I pleased to present? Profit is down and is back.
Yeah, you give away for trouble, you know. Because I know, you know, there are certain companies that have reported losses, and that we are pleased to present 200 million down. Like,
right. And I'm saying, I don't want to tell, so I move away from that and try to identify some news. I'm an optimist by nature. So unless I particularly want to send you shocking news, I'm going to try and identify some positive things that I believe people, you know, I just got a report and the thing start off, boy, the pandemic, this and that happened from the pandemic. But I say, you can find something in the stuff and put out the most pleasant bad news you can have. Because once you start out that way, people are not, once I read the first couple of lines, and not going any further.
So primary for bad news.
You waste all the time and the effort to do the report. So I guess, in a sense, there needs to be a course, some training session to help people to focus on putting these things together, right? And because I found that too often people just, oh yes, this is traditionally what happens, so we're gonna say that. And I say to people, I mean, you know, I get things coming, and I say, but I don't want to say that to the shareholders. I don't have to say it to the shareholders, right? I mean, you guys have gone through the access thing, and I'm saying, yeah, people are focused on access. Why do we have to focus on the access? We've made it. We invested, and we made a conscious effort to buy. We never even get all that we ordered to buy. And
Really?
it happened that when we bought it, the price moved up. We buy it at 32. It was at $40-something, and then the price came down, and then you have the pandemic that made it worse.
Yeah.
But
and the truth is,
if your values are improving, and if you're satisfied that is going to go there, the thing has stabilized, so we move on. If people want to hear from us as to what we're going to do with it, and we're convinced that is important, then one may deal with it. But even for my style, I'm not necessarily going to. Well, it depends on what wants to be done with it. But as I said to people, we don't have only one non-performing investment in there. So if you start to talk about one, you might have to talk about all of them. And what is important at times is the movement. When things are moving in the right direction, then one can focus on that. If things are not moving in the right direction, then you have to start to tell your shareholders what are the actions you're going to take to deal with things, and you might then have to deal with the individual ones. So listen, if we're not already done so, we're looking at getting rid of this or getting rid of some of them and redeploying them elsewhere.
I like that. I like that sort of proactive. I like that sort of proactive management. And well, it brings me back to the retail investor point, because we're now facing a market with the strongest retailer base that we've had before. I've heard, don't hold sprinkle salt on these numbers, but I've heard numbers of 14,000 JTrader users, and it would mean that these are active people trading from their cell phones or from their computers themselves.
Yes.
Which then means that the retail base now has more power than it has had in, I don't know if maybe ever.
And that's a fair, I think that ever, I think is appropriate word.
Yeah. And then that then speaks to companies now needing to speak like you're speaking to everybody, because you don't know. I personally, I'm not going to go to every AGM. Not often is there a need to go to every AGM, but if I have a need, I will go. Other times I might read about what happened there, I read it in the financials.
My recommendation for AGM, I used to go to AGMs regularly, and one of the advantages of going to AGMs is the opportunity to rub shoulders with the movers and shakers of industry, right?
True.
So I tell this story. My first article on Grace Kennedy was done years and years ago, as you probably would assume. And my first article is something that sticks in my mind. I don't remember the contents of the article fully, but what's stuck in my mind is that I had put a call through to the company that I wanted to do an article, and I wanted to have met with Carlton Alexander. So I put the call through, maybe on Monday morning, what have you, expecting fully well to be told by a secretary that, first of all, who are you, where you're calling from, etc. And Mr. Alexander can't talk to you, he's busy, and maybe you might want to call back in a few weeks, or he'll call you back in whatever. So I went unprepared for any instantaneous encounter with the gentleman. Right. I called. Lady said, let me see if he can talk to you. And in seconds, the man was speaking to me. And it's, so I said, well, I wanted to write an article, do an article. I'm in the process of doing an article, so I wanted to have an interview. And he said, when do you want to come? And of course, I wasn't prepared. I had no time frame because I expect the thing to be somewhere down the road. And in a few days, I called Brett and told him maybe next week or whatever it is. Went down, did the article, and he said, well, it's the first time anybody, but I contacted them. But the thing is that here is a man that was a super business person in the society. And I was able to get through to him. No layers and layers of secretaries to go through. And I got my interview done in no time at all. And but you know, so the ability to go to AGMs, because the directors don't, most people who are, so if they go there, they have an opportunity to discourse with them, which makes you, if you have to try and get information from the company, it provides an opportunity that once you put the call through, the person knows who is calling, and is prepared, all things being equal, to entertain their questions. And it's something, as well as to intermingle with other investors. Because that the whole matter of investment is not purely what I know, but is also what other people know and what you can interact with them and get information from them that may be useful in investment decision making.
I love that. Hi guys, Randy just reminded me again that what you just heard was part one of a two-part thing. We didn't want it to go too long, so we edited it to give you a lot of the gems, but not keep you bored, all right? I hope you enjoyed the conversation. There's more to come. If you liked it, like, subscribe. If you're listening to us and not watching us on YouTube, feel free to subscribe or share with a friend, or if you're listening on Apple, 5 stars, leave a review. Thank you, really. I hope you enjoyed it, and look out for part 2 coming up soon, all right? Good.